Good evening, everyone. I'm here to talk about the transformation that's underway at Thorntons, to talk to you about a business that has a long and proud heritage, one of Britain's great last standing, if you like, vertically integrated manufacturer and sort of retailers. More of that in a little while. And I guess from an investment point of view, to suggest to you that we've only just begun in many ways, and that we have in front of us an opportunity that is quite amazing. We're very excited by. I want to just give you a bit of a flavour about the business, its heritage, the plans that we've put in place to transform our business, the journey so far, and a little bit about what lies ahead of us. So for those of you that have seen the journey of the share price, it did hit a low of 9.75p 2 years ago, and today I think it's around 140 pence. So just to reassure you that from our point of view, there's still plenty to go at. So 103 years of making customers smile, started by Joseph William Thornton back in 1911. Business floated back in 1987, obviously a family company right the way through those years, for good or for not. And since then we've been fully listed, and the business that you see today is still listed as a retailer, although as you'll see, quite a long way from just being a retailer in today's world. We're British, we're proud of it. We make over 90% of the products that have Thornton's name on it in our factory in Alfreton. It's a freehold site. It's about 64 acres, and we make over 20 million kilograms of chocolate through that facility every year. So Britain's proudest, largest independent chocolate business. We have what I would call today a multi-channel model, and when retailers talk about multi-channel, they generally mean we've got a website. But I do truly mean we're a multi-channel business. We're a vertically integrated business, so at the heart of it, our manufacturing, and we have two key operating divisions. Our retail division that includes our own stores, for which I guess all of you are relatively familiar. We currently have 281 of those stores, more of which in a little while. Our franchise business, which just to be clear is not a franchise Thornton store, but it's generally an in-plant, for example, 7 metres within a card and gift retailer, for example. We have 184 of those, so 450, 60 points of presence on Britain's high street still, and a big commitment to it. And we have a website, our customer direct business, which supports that retail division. Our FMCG division has within it our very fast-growing and soon to be our largest channel, which is UK commercial, which in addition to serving the main grocers, all of the main grocers, we have a very large number of other third-party retail relationships through which we sell our products. And we have also within the FMCG division our nascent international division, which we've renamed recently from our export division to evidence our ambitions from a very low base to take our business overseas in a very positive and structured way. The size of our opportunity maybe is obvious, but it is important for me to point out everybody loves chocolate. Nearly all adults consume chocolate. Over half of them buy chocolates in our sector. And in terms of people who actually express a preference and our core market, we have about 4 million of those. So that doesn't mean that no more do, but it just means that our core customers are around about 4 million in the UK and remain a significant opportunity to expand. The market has been pretty resilient in the last few years since the recession, as consumers have become engaged with chocolate, and I've seen in chocolate as sort of an affordable treat in these tough times. In terms of gifting, people choosing to, instead of buying something else and a box of chocolates, have certainly retained the box of chocolates element. So we've seen that become a standalone gift in that period of time. Market driven very much over that period by value rather than volume. but nevertheless seen through the difficult times with a reasonably positive performance. We're also focused on the broader gifting market, which for us gives us a different perspective on the opportunities that are ahead of us. And if you look at that, the overall UK confectionery market is a little under £4 billion, £3.8 billion to be precise. At around 10 times that size is the overall gifting market, of which there is chocolate gifting within that. And that chocolate gifting market is also holding up very well indeed. And certainly in terms of our strategic intent, we want to get further onto the consumer's consideration list for year-round gifting, not just I want a box of chocolates. And that's very much part of our strategy that I'll outline. Our brand remains strong. If you took all our sales and you grossed them up to retail prices, we take something in excess of £300 million in the overall market. Our market shares continue to grow. I won't dwell on all of them, but I will point out to you that in our heartland inlaid box chocolate market, as measured by Nielsen, who measure essentially the grocery market, we have over a third of the market, 35% of the market there. And if you added back in our own channel sales, we probably have somewhere between 30 and 50 pence in the pound spent on every box of chocolates in the UK, which I think evidences the strength and the enduring strength of our brand. Spontaneous awareness is high, and our advocacy is high. We've been focusing also very much in our own stores on consumer satisfaction, and we've seen some very encouraging improvements from an already good base to an outstanding level over the course of the last 18 months or so. So where have we come from? We've come from what I would describe as a UK retail business with growing commercial sales. When I arrived, commercial sales being our word for wholesale distribution. I think we've come from a place where our profitability was low, our brand clarity was weak, and we lacked confidence as a business. Where are we now? We're a UK multi-channel business. Our profitability is improving, our brand positioning is gaining clarity, and we are growing confidence. This is the one-pager, which I won't read out to you, which we use internally as a way of summarising our vision, our strategy, our values. What I will refer you to is the second band down, which is our strategy. 3 R's: rebalance, revitalise, restore. Rebalance is about growing our FMCG division sales, selling our products where our customers want to buy from us, and reducing our retail estate to a sustainable, profitable level for the longer term. Revitalise is about being clear about our brand positioning and encouraging our customers to purchase from us more frequently. Typically, more than 50% of our customers buy from us only once or twice a year around those key seasons. Our challenge, as I've already said, is to encourage customers to put us on the consideration list for all year round gifting, those just cause occasions, anniversaries, birthdays, etc. Restore is about profitability, naturally, not just about pound notes restoration, but also about relativity to the market expectations for a business that is a unique blend of retail and FMCG. Rebalance is really important to us. Why is that? From the consumer point of view, it's about putting our products in front of our customers where they want to buy from us, but particularly Rebalance grows our FMCG division and reduces our retail estate. We're making very good progress. We're on track with our programme to reduce our retail estate from around 360 odd stores when we started the programme down to a medium-term ambition of 180 to 200 stores, still a sizable estate. We're on track with that programme as we speak today. And the simple mathematical financial equation to draw your attention to is at the bottom of this slide. Our FMCG divisional contribution margin, our net margin, is around 21%, and our retail divisional net margin is 2.5%, so around 10 times. So Rebalance is all about growing a 21% contributor and reducing a 2.5% contributor. At the same time, trying to increase the 2.5% and hold on to, maintain, grow if we can, the 21%. Revitalise is about clear brand positioning. This is about understanding where we sit in the marketplace. I call it mass premium. It sits between the mass market and the premium market. It's worth paying that bit extra for. We are looking to strengthen our brands, as I've already said, both in those areas where you have planned gifting, which we're very famous for, but we're looking to grow in those unplanned, spontaneous gifting occasions. And we understand very much what our brand is nowadays. It's not just a chocolate brand, it's a way of communicating. It's a medium, if you will, of saying what you feel in terms of emotion and sentiment. Sorry, well done, congratulations, I love you, etc., etc. So chocolate as a medium. Whatever you want to say, we've got a chocolate for that. So this is about planned gifting on the left and impulsive gifting on the right. It's about revitalising our range through packaging. It's about making sense of what was a very large and now reducing kaleidoscopic presentation of products that made it very difficult for any consumer to make choices, to understand our propositions. We've created a range of platforms for our business, of which we're now aggregating all of our products under platforms that are all customer driven. So here you can see our Classics brand on the right, which I believe it looks a strong sub-brand. It's easy to shop. On the left you can see what it looked like when we started. It was a disjointed mishmash of products. It was very complex, and as importantly, it was inconsistent across channels. You couldn't buy the same product across our channels. It made it very complicated for our customers. We've done the same with what we call nostalgia. These are all internal titles. This is our toffee and fudge. On the left you can see a range that lacked personality. I think it was rooted somewhere in sort of Eastern Europe, 1949, I think. It was really heavily dated. It wasn't really Eastern Europe, 1949. After, here you can see, visually engaging, quirky, consistent, yet still leveraging the heritage that we have in toffee and fudge. Indulgence, a range, again, that beforehand that lacked strength and consistency with some excellent products, easily lost, and now a powerful, coherent range, much of which you can see outside today, really looking like the indulgent platform that we intend it to be. So, improving profitability. Our business last year delivered an EBIT margin of 3.3%, which was a significant improvement on the very weak profitability of the year before that. We believe that this business should be able to do significantly better than that. As I said, a blend of a retail business where we think we should be able to deliver reasonably single-digit EBIT margins, and an FMCG business where we would say we should be able to deliver a double-digit margin. So I'll leave you to work out what you think that we can do with this, but I think broadly speaking there's significant vision through to at least double the current level of EBIT margin that we're delivering today. Rebalancing, that I've already explained, is the key driver to our margin improvement, reducing that exposure to that low net margin business and growing our higher net margin FMCG division. And we have a number of levers internally, because we don't create products on production lines that run 24 hours a day creating Mars bars. We create a number of products and we recreate them in batch over the course of, and we recreate it over time, which affords us the opportunity to create levers of product and packaging engineering, ingredient optimization, etc. And we continue to deploy a very aggressive approach to cost management in the business. This is our financial history. As you can see, over the last few years, we've gone from a low of a PBT of barely a PBT, 0.9 million the year before last, to last year's 5.6 million, and you can witness on the third line the EBIT margin progression in that time from that low of 1.3% to 3.3% today. You can see at the bottom how our rebalancing strategy is playing out over time as we grow FMCG and we decline our own store numbers. For good order, rather than my own forecasts here, I have put the next 2 years market consensuses to evidence the belief in the progression that we can deliver over the next couple of years. Which leads me to the opportunity ahead and my earlier comments. After 2 years of our 3-year plan, the question was being asked, so what next? Where do you go next? Are you just a one-trick pony, or are you going to go further forward with this? And I'm pleased to say there's much more ahead of us. Our view is that the strategy is working. We're clearly evidencing it, and we don't see any fundamental change to that direction going forward. Our continued focus on margins and profitability remains. What we are seeing, and what we do have a confidence now, is that if our first 3 years were characterised by a rebalancing of our sales and volumes between channels, the next 3 years will start to become characterised by a continuation of that, plus top-line growth, fundamentally driven by a confidence that we can continue to grow our sales through our UK commercial channel, and from a very low start point, start to add incremental sales in our exciting developments on an international platform. So what does that mean for our vision of how we see our business evolving from where we are today as a UK multi-channel business? We look to the future as an emerging international FMCG business and UK multi-channel retailer, with profitability aligned to industry competitive returns, our international opportunities starting to be realised, and with a strong and confident business and brand. Our current trading was released a couple of weeks ago that covered our important Q2 trading period, so I thought it was important that, given that was the last public data, I should just at least share that with you with a couple of comments. I'm very pleased to say I think it was one of the, sort of other people's words rather than mine, one of the strongest trading statements that the company has ever issued, I've been suggested, and so we're very proud of that, but not complacent. There's much more to do. Overall sales in growth, top-line sales, most of those top-line sales being made in the UK, so in a tough market still, growing overall sales for the business at a very healthy level. Importantly, our FMCG division growing significantly at over 17%, and within that, our UK commercial channel, the engine of our future growth, driving forward very strongly by over 20%. In our retail division, whilst our overall sales were down, this was mainly driven by our store closure programme, which is part of the strategy and is on track. We delivered like-for-like growth of 3.5%, which was the best Q2 Christmas trading performance since Christmas 2006. And from a position of weakness 2 years ago, or 2 Christmases ago, we were very pleased that our consumer direct, our online business, was on track and showed what opportunity there remains within that channel for us, sales up by 27%. And lastly, within our retail division, our franchise business, which sometimes gets overlooked, but is a very good bellwether of how businessmen with skin in the game, running their own stores, see our brand. I'm very pleased to say that over the half, shipments were up 5% in our franchise business, which I think again evidences that other people who have, as I say, got their own skin in their game with their businesses are both supportive and benefiting from their continued commitment and investment in the Thorntons franchise. So, ladies and gentlemen, there's a quick trot through of the journey so far, and some a little visibility of how we think the journey can continue. It's an exciting one. I can't say that it isn't fun running a chocolate company. If I'm Willy Wonka, then Mike Killick is my chief Oompa Loompa. Mike is our finance director. He's here tonight to help answer questions, whether in the room or afterwards. It's been a pleasure. I don't know how long I've taken, but it seems like I've gone in 5 minutes or something like that. There's plenty in the pack that I haven't talked about. Obviously, I'll be delighted to answer any questions. Mike and I'll be delighted to answer any questions. Thank you very much.